Amazon's board of directors approved a $10 billion stock buyback, replacing the previous $5 billion buyback program, plus a major 20-for-1 split of the company's common shares, where trading would begin on a split adjusted basis on June 6th, provided that the action is approved by shareholders at the preceding May 25th annual meeting. So to dive further in on the details and the reason that Amazon made this decision, we've got Jared Woodard, who is the Bank of America head of the Research Investment Committee, joining us now. Jared, good to have you here with us this afternoon. Why was this the right time for Amazon to make this decision?
I think it's the right time because the management of the company, like so many other corporate managers lately, are realizing that it's a good moment to signal friendliness to shareholders, whether you do it with a stock split, a share buyback, or some other means, raise your dividend, for example. Companies are increasingly sensitive to the fact that markets are more volatile, liquidity conditions are getting tighter, and investor flows into equities have slowed down after a record pace last year. And so the stock split is just one more method for signaling to shareholders that managements care about their interests and are eager to keep them satisfied. This has been one of those corporate actions that has slowed down in recent decades, but we looked at data since 1980, and we found some pretty surprising results. Historically, the year after a company split their shares, the average return 12 months later was about 25%. And that's much better than the market average. Market indexes were up only about 9% over the same period. So it seems like stock splits have been an indicator of a company that's performing well and is poised to continue to do well even after the shares, are split.
Okay, and so keeping with that thread, timing here, critical. Tech companies, they would have a good sense of exactly the path that the Fed would take, at least at this point in time, from what they've been signaling thus far. So for tech companies, they have been keeping a close eye on what the Fed may announce. And for this effective split, what does that do in terms of altering their anticipated performance post-split, knowing that there is that headwind of the Fed?
I think that the most important issue when it comes to corporate plans for the future to keep in mind is really about what companies are able to do with the assets they have on hand. It's fairly well understood by the market, corporate managers, investors, and everyone else that the Fed has some hikes that they need to enact this year and next year. Stock prices have moved already quite a lot this year in response to those expectations. I think what matters the most in the future is the ability of managements to take care of their shareholders and take care of their core businesses. And the good news on that front is that corporate America is sitting on a record pile of cash. U.S. companies have $7 trillion in liquid assets. That's a record high. And it gives corporate managers incredible flexibility, whether to invest in their businesses through CapEx, to raise buybacks and dividends, to reward shareholders, to do stock splits, or just to sit on that cash and keep their balance sheets cleaned up, pay down debt, and stay safe for a rainy day. That flexibility is incredibly valuable. And it's one of the reasons why we see a lot of managements of companies using some of that capital to shore up their position relative to their peers.
Sure. Jared, this is not the first time that we've heard of a 20-to-1 split over the course of this year. Of course, Google parent company Alphabet had announced one earlier. And this really kind of throws us into the conversation of a play for the price-weighted Dow Jones Industrial Average. And what exposure would that provide Amazon or Google in existing portfolios that don't already own the stock? Do you believe this is a play for either one of these names to try and get into the Dow?
I don't know if it's on the minds of management or not. It's certainly something people talk about from time to time. I think the most important consideration is to make sure that their shares are accessible to the average investor and to signal that they're more attentive than ever to shareholder concerns. It's not just Google, it's not just Amazon. We looked at the S&P 500 and found 20 other companies with share prices today that are above $500 a share. So if your concern is to get that share price to an accessible level, there's some pretty interesting candidates that might be next to come. We saw companies like AutoZone, Chipotle, Tesla, BlackRock. There's a lot of consumer companies, some tech companies, but really a wide range of firms that have high stock prices, plenty of cash and flexibility, and I think a desire to be attractive to shareholders, for regular investors. So this may be just the first two data points in what could become a growing trend.
First two data points this year. I love that full screen that we just threw up, and I don't know if we can toss it back up there on the screen just for a hot second. We had Apple and Tesla go through with their splits most recently prior to the big tech names that we saw come through this year in Amazon and Alphabet. And there you're seeing the timing of Apple's and Tesla's as well in August of 2020. What company could be next to announce a similar split? You didn't mention Netflix there particularly, which is an extremely consumer-facing company.
Right. It's impossible to predict what managements are going to do, and there are quite a number of firms. I think that the most important thing to keep in mind is that managements are eager to keep their shareholders happy. And so when you're looking at companies that have had really strong inflows of the past few years and really strong returns, if you find yourself in a more volatile market, exactly the kind of market that we have today, it seems like those are the ideal conditions for managers to take some of these actions to make themselves attractive. It's very easy for a company just to continue with business as usual, especially companies that are throwing off lots of free cash flow. We think that a stock split is a pretty attractive, very free and easy way to get the attention of shareholders. If you pair that with a buyback the way that Amazon has done this week, it makes the argument to invest even more compelling.